This is Mastering Your Wealth with David Gagnon, the podcast.
Ray Dalio is the billionaire investor who started the Bridgewater Management Group, and he wrote a book called How Countries Go Broke. He says our economy is like a human body. Plaque builds up over time and finally causes a heart attack. Our nation's debt is like that plaque, David, and we are headed for a possible crash here. So could debt be the next black swan event?
Well, that analogy resonates with a lot of people right now because debt problems don't usually explode overnight. They build quietly, year after year until something finally gives. And from a retirement planning standpoint, the key question isn't whether Ray is right or wrong. It's how exposed are you, even if he's partially right. So when clients hear the black swan, they often assume it means sudden market collapse that wipes everything out. But really in retirement planning, the real danger is more subtle. Rising debt can lead to higher taxes, currency pressure, inflation, forced policy changes, any of which can quietly erode your retirement income over time. So, I was just thinking about a couple who came in a few years ago with a very traditional portfolio, heavily concentrated in U.S. stocks and bonds, with almost no diversification outside the box. The concern wasn't market crashes, it was longevity. They wanted to know, what if the rules change while we're retired? And could they sustain, for the rest of their retirement years, what their spending objectives were? So, it really comes down to not trying to predict the next crisis, but we try to focus on resilience, spreading risk across different asset types, income sources, tax treatments, and rebalancing away from the overly dependent government promises and interest rates or single market outcomes. We want a well-designed, personalized plan that's really aligning their investments, their income sources with what their needs show us in their analysis that they're going to require to make it all work. So, that's the advisor's role, and eliminate the fear-mongering, but stress testing a plan against uncomfortable possibilities so clients really aren't focused into a reactionary decision later. You don't want to be reactive in your financial decisions. And that's why on the front end, you want to be proactive because you can align your money with your plan objectives and then have safeguards and backup strategies for those events that we can never really predict that could occur. That could hurt your money, such as market drops, out-of-pocket health care. The death of a spouse will change financial dynamics in your planning. So we want to take a close look at all that and have the plan on the surface for both spouses, but then a backup plan when these other events could occur that could derail a retirement. And we see this, unfortunately, happening a lot because people aren't working off of a plan with their retirement.
Yeah, and when we say a plan, folks, it sounds like that easy four-letter word, PLAN, right? But I'm talking about something in black and white, not just in your mind going, well, I have a 401k. I guess social's going to be there, too, to help me. And, I don't know, I have some other savings somewhere or inheritance. I guess that'll work for me. That is just an idea. A plan is sitting down with David and saying, okay, let's look at plan number one, and then let's have a backup, and then if we might need another backup. And over the years, you're going to continuously tweak this plan. This is not just a one-time set it and forget it thing.
Yeah, well, when you talk about and refer to somebody's retirement nest egg, whether it's 401ks, brokerage accounts, savings, those are tools. And the key is, how do you coordinate all these tools into a plan that addresses a lot of different objectives that a plan might require, such as how do you mitigate risk? Not just market risk, but longevity risk, interest rate risk, inflation risk, healthcare risk, tax risk. There's all kinds of risks that could affect your money in a bad way without a careful plan that it kind of looks at all those areas and incorporates strategies to try to mitigate as many of those risks as possible. And it's the stuff that's in somebody's blind spot that could be hurting their money. They don't see that what they might be doing currently in their financial decisions might be costing them. And we've been doing this for decades. We kind of see where the leaky holes are in your financial buckets that maybe with another set of eyes looking from the outside in can identify those areas that are highly inefficient and help people fix those problems that they don't see. And that's why when we do planning, it's a great exercise for folks that work with us because we can identify these problems that if they go unchecked for years, that could change the outcome in a not a very favorable way in your retirement. And so building efficiency and all these financial decisions, coordinating all these moving financial pieces to your plan can pay big dividends long term and having a sustainable retirement with a high level of success, predictability, and eliminate the financial anxiety people live with day in and day out because they don't know if they're doing the right thing because they're not working off of a good plan design.
Mm-hmm.
And your best decisions come from looking into the future with what you're doing today with your money to see what problems lie ahead. So we want to look into the future, see if you're on track. And if not, we'll identify if you're going to run out of money, if you're taking too much risk, paying too much in taxes, not receiving enough rate of return to make it work. And when you take the guesswork out of these moving parts and you put a real plan together with a good strategy that addresses some of the things that we can do to make things highly efficient, then things are going to work better and you're not going to have to worry about spending your money because we can validate what's going to work and whether you can maintain your lifestyle or not. And if not, there's tools and techniques that could be implemented to make it all work. It's not something you want to put your head in the sand on. You really need clarity and some direction as to really what's going to work most effectively.
Yeah, and you talk about finding direction. Just to give you guys an idea here, David, you've been doing this for nearly 40 years, guys, 4 decades. David has been around helping people just like you plan for your retirement. And I want to make it clear to our listeners here as we talk about putting a plan together. By the way, every plan is customized. There is no cookie cutter approach here. And I think a lot of people misconstrue who needs a retirement plan. Somebody might have, I don't know, $500,000 saved and go, I don't have enough to make a plan. I mean, those are for the ultra rich people. Can you just kind of explain that to our listeners? I want to make sure that they're not counting themselves out of working with you because they think they haven't saved enough.
Well, for those that may not have the large nest egg, say they're $500,000 or less. They're the ones that need the most help because they cannot afford to make a mistake because they don't have enough cushion to make mistakes. Now, we deal with very wealthy people and wealthy folks that are very financially well off from a savings perspective. Say they have a large nest egg, and we can point out problems that they might be exposing their money to, such as excessive market risk. But we can kind of stress test their numbers, and we show them, if you lost half your money, it's not going to change your lifestyle because they have that much of it. For the folks that don't have the luxury of having that sum of money, those mistakes, if they're made, changes your lifestyle. So if I had $500,000 and I lost 20-30% and it didn't come back in a very short period of time, that's probably going to change your spending lifestyle and retirement, and you're going to have to make some difficult decisions. So for the folks that aren't in a position of being so-called ultra wealthy, they're the ones that typically need the help and need a plan that's sustainable, that's predictable, that has some guarantees built in. You don't want to run into a situation where you've made a bad mistake with your money and then sometimes you can't recover from that if you don't take care of it when you can. And that's why, people are getting very complacent now. The market's been on a steady increase for a long time. Back in the late 90s, remember the tech bubble was building up in the late 90s?
Oh, yeah.
And the stock market, didn't matter where you invested in the market. You basically had 5 companies, 6 companies, 7 companies driving that stock market up. It was a buying frenzy. People were just buying stocks everywhere. And then the tech bubble burst. And then the market went down for 3 years in a row. And then it started to steadily increase. And then we had the mortgage and the financial crisis, 07, 08, and people were down 40, 50%. And now it took 4 to 6 years to recover from that period. And it's been a long time since then, right? Before we haven't had a big correction. 2022 was not a good year in the market. But people get complacent. They let their guard down. They think everything's fine. They see the values in their accounts being pretty high. But now they're still vulnerable to the next correction, whenever that might be. And this is what we show folks. We show them how much risk they're exposed to, what kind of returns they're getting, what kind of fees they're paying. But now, how do you protect those values? And that's where it's so important today. Be proactive. Employ the right investment strategies, tools, and techniques so that you're going to benefit if the market continues, but now you have an airbag system on your money so you don't get beat up like in what happened in 2001 and 2 and also in the financial crisis of '08. Because if you're really getting close to retirement or in retirement, boy, you're so vulnerable at this stage of the game, and it doesn't have to be that way. Because a good investment plan strategy with the right techniques and proactive management can help put some safeguards on that. So you can see there's a lot of moving parts to managing your money, making good decisions. And we've been all over the place and talking about the market risk and ways to safeguard your planning. And for those that are really listening and they don't have a plan or they need a second opinion or they want the clarity as to whether they have some opportunities to better understand their investments, but also more so protect those investments while the market's still in a favorable value position for them. So for those that are listening, and if they really want to reach out to us to do the comprehensive portfolio x-ray, we'll do that, $1,000 value. And at least that gives somebody the ability to better understand how they're invested. You have some clarity, and now gives us an opportunity to have a little discussion as to whether their investment plan strategy is truly aligned with their personal short-term and long-term goals and objectives with their money. And then we also have conversations about some of the other things that could impact them either in a favorable way or a negative way with what decisions they're going to have to make going forward, whether it's coordinating Social Security timing strategies, pension maximization, tax planning, and so on. So if you want help in your portfolio review and analysis, give us a call.
And you can do that today. Reminder, it is complimentary, 203-872-0009. 203-872-0009. Again, that website, masteringyourwealthradio.com. You know, before we've talked about how it's so important to look at interest rates when it comes to refining. Let's say you're going to refi your home. Well, obviously you're going to do that when interest rates are lower than what you currently have. Interest rates are high. It's kind of stay steady until things settle down. So interest rates were going up, right? We've had many move their money into short-term bonds, that kind of deal. But as rates are going down, some suggest you might look at longer-term bonds. I want to know, where do you look at this in this environment here, David? Is there another play here? Especially when they say interest rates aren't going to move any higher. It either tells you we're staying course here or we might see a dip at some point.
Well, you know, this is where a lot of retirees feel whiplash, right? For the last few years, everyone was told to hide in short-term bonds and cash. And that worked temporarily, but now as rates start moving lower, that strategy becomes less effective. You know, longer-term bonds can benefit when rates fall, but they also introduce price volatility that surprises people who thought bonds were safe. And that's exactly what confuses a lot of people. They assume bond funds or bonds mean stability until they see their bond values swing and when rates move. So when you look back to 2022, we did a lot of portfolio analysis for folks because the markets weren't doing so well. And, well, shocked a lot of people. A lot of people were in the traditional allocation of being 60% in equity funds, 40% in bond funds, and they couldn't believe how much value they lost because in their mind, they had bond funds as an allocation in their mind as a stabilizing factor for their account values. Well, bond funds got beat up pretty good. And they didn't realize that they could lose that kind of money. You know, some analysis we did, some bond funds were down 18 to 22%. Ooh. So the bigger conversation isn't which bond to buy. It's what type of income class or asset class in fixed income can give you a better result for generating income. Now, we use alternative investments in the fixed income marketplace that are steady yields, they're short-term yields, they're much higher yields than the bonds and the bond funds, and some of them are structured income notes, and it's something we use almost in every client's portfolio because of the consistency and the high yields that we can generate to create good cash flow. And so, like we always say, we look at what the wealthy people are doing. We employ the tools that the wealthy people have access to. And a lot of people don't get access to that type of opportunity because those firms, if you're going to become a client, require minimum account sizes of 5 million up to 50 million.
Wow. What?
Okay. So, the wealthy are wealthy for a reason. They're always doing things differently, and they're thinking outside the box. They're using alternative investments, proactive tactical money management, and we give those benefits to our clients. We're in a position to do that. You don't have to be ultra wealthy to have those advantages in your planning. And so, I can't remember the last time I used bonds or bond funds since we've been using alternative income tools. And there's other things that can generate income yields and, dividend stock portfolios that are tactically managed. We use a lot of that. Guaranteed income vehicles to employ some predictability and good payout distribution rates that will be there for as long as you live. So income planning is the key to a successful retirement, a strategic income plan that's aligning your investments for the income yields that you need to generate and align that with a good tax withdrawal strategy and make sure your investment strategy is aligned with those other two of the three-legged stool when it comes to income planning. And we model this all out. And we put a strategic, personalized plan in place for folks when they're in retirement so they know where to invest, where the money's coming from, when it's coming from, those resources. And then we're also able to incorporate other long-term planning with their investments for growth, tax efficiency, and so on.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims-paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure of the ADV 2A Item 4 for additional information.